All right, let's dive right in. Today, we are cracking open one of the most powerful and honestly, one of the most misunderstood numbers in all of finance, the VIX. You've probably heard it called Wall Street's Fear Index, and that's exactly what it is, a real-time thermometer for market panic. And look, if you want to understand risk, you absolutely have to understand the VIX. So let's get into it.
But here's the thing. This isn't just some abstract number on a screen. It has very real and sometimes, well, devastating consequences. So the big question we're going to unpack today is this. How did this one little index cause over $2 billion to just vanish in a single afternoon?
So, what is the VIX, really? Officially, it's the CBOE Volatility Index. But what that actually means is it's a live number that measures the market's expectation of how wild the S&P 500 is going to be over the next 30 days. See, it's not about what's happening right this second. It's about what traders are betting will happen next. And that's why it gets that famous nickname, the fear gauge.
Now, I love this slide because it basically translates these weird numbers into plain English, into emotion, really. So if you look at the chart, a VIX value way down around 12, that's an extremely calm market. Everybody's chill. Around 20 is pretty normal. But once you start hitting 30, we're in high fear territory. And if you ever see the VIX hit 80 or higher, well, that means you're living through a historic crisis, like the 2008 meltdown or the 2020 pandemic shock.
The most fundamental thing you have to know about the VIX is that it acts like a seesaw with the stock market. It's almost a law of nature. You know, about 80% of the time when the S&P 500 goes down, fear goes up, and boom, the VIX spikes. And when the market is rallying and everybody's feeling good, the VIX just kind of melts away. This inverse relationship, this is the key to our whole story.
So, this predictable seesaw behavior led some very smart people to a seemingly brilliant idea. If fear always spikes and then always fades away, what if you could just bet on things returning to normal? And this, my friends, gave rise to what a lot of people started calling the money printer trade.
And on paper, the logic seemed absolutely bulletproof. First, the VIX is what we call mean reverting. It just doesn't stay high forever. After a crazy spike, it almost always falls back down towards its average. Second, there's this thing called the volatility risk premium, which is a fancy way of saying there's a natural cushion that tends to favor people betting against fear. And third, the most important piece of this whole puzzle, a powerful structural tailwind called Contango.
And that last point, Contango, well, that is the most critical and, as we'll see, the most dangerous part of this entire story. It was the secret engine that made the money printer go brrr, but it also contained a hidden, fatal flaw.
Okay, stick with me here, because this part is absolutely crucial. The VIX futures market pretty much only exists in one of two states. Most of the time, around 80% of the time, when markets are calm, it's in what we call contango. All this means is that futures contracts for, say, next month are priced higher than this month's contract. The opposite state, backwardation, really only happens when there's a ton of fear and the current VIX price spikes way above the future prices.
So why on earth does this matter? Well, think about it. Products that track the VIX have to constantly sell the contract that's about to expire and buy the next one out. Now, in Contango, that normal, calm state, this forces them to systematically sell low and buy high every single month. This creates a constant downward grind on the product's price, something we call roll decay. But for the products betting against the VIX, it's the exact opposite. They get to sell high and buy low, collecting a steady profit called roll yield. That was the engine of the money printer.
And if you want to see just how devastating that roll decay is, just look at this number. This is what happened to anyone trying to bet on rising fear long-term. The VXX, a really popular product, has lost over 99.9% of its value since it launched, all because of that constant grind from Contango. I'm not kidding, its split-adjusted price went from over $400,000 to under $50. It's just brutal.
Okay, so with all that in mind, picture the year 2017. The market was bizarrely calm, like historically calm. The VIX was just stuck in the basement, and Contango is king. For an entire year, people who were shorting volatility just sat back and collected that sweet, sweet roll yield, month after month after month. It honestly felt completely risk-free. And of course, the trade got incredibly crowded. And then, the day of reckoning came. It all came crashing down on one single, unforgettable day in market history. February 5th, 2018. A day that would earn the nickname Volmageddon.
So the stage was set in 2017 with that crazy calm.
On Friday, February 2nd, 2018, you get this little inflation scare that spooks the market, and the VIX pops from about 13 up to 17. It was a warning shot. Then, on that Monday, February 5th, the stock market just starts to tank. And the VIX, it didn't just rise, it exploded. By the market close, it was at 37. But the real damage happened in the after-hours session, when all those complex short VIX products were forced to rebalance, creating a death spiral. By the next morning, it was all over.
The official number is it's staggering. In a single day, the VIX more than doubled, a move of over 100%. The sheer speed and violence of this spike was something that the computer models that built these products had literally never seen before and never thought was possible.
And here is the direct result of that spike. The most popular short volatility product out there. Its ticker was XIV, which had been the darling of the money printer trade for years, lost 96% of its value. Overnight. Between the market closing and the next morning, poof, gone.
The casualty report from that day was just brutal. $2 billion in XIV's assets vaporized. The product was just terminated by its issuer, Credit Suisse. Another one, SVXY, somehow survived, but was forced to slash its leverage. And maybe most tragically, thousands of regular retail traders who had piled into this safe trade saw years of their savings completely wiped out in an instant.
So what? What can we possibly learn from all this financial carnage? Well, this whole event is the perfect illustration of one of the oldest and maybe one of the wisest sayings on Wall Street.
And that saying is this: shorting volatility is like picking up pennies in front of a steamroller. For months, maybe even for years, you get to bend over and collect these small, consistent gains, the pennies. And it feels amazing, it feels easy. But you are completely blind to the low probability, high impact risk of the steamroller that is silently, slowly heading your way. And when it finally arrives, it doesn't just take back your pennies, it takes everything.
I mean, this slide just perfectly captures the psychological trap of it all. Year 1, you're up 30%, and you're thinking, wow, this is easy, steady income. Year 2, you get more confident, you add more capital. By year 3, you're convinced the risk is minimal because, hey, everyone else is doing it too. And then the black swan day arrives, and that slow, steady climb up the mountain is erased by a catastrophic fall right off a cliff.
So the key takeaway here isn't that the VIX is just some weapon of mass destruction. It can actually be an incredibly useful tool if you know how to read it. If you're a long-term investor, a VIX spike above 30 can be a great signal that fear is peaking, and it might be a good time to start buying. If you're a hedger, a really low VIX means portfolio insurance is on sale. It's cheap. And if you're a speculator, well, the lesson from Volmageddon is simple. Respect the risk. Always assume the VIX can double overnight, because, as we've just seen, it absolutely can.
In the end, the story of the VIX and Volmageddon is just a brutal, real-world lesson of this famous quote from John Maynard Keynes. The market can do things that seem completely impossible longer than you can possibly afford to bet against it. That tail risk, that tiny, tiny chance of a catastrophic event, it's not just some theory in a textbook. It's a guarantee if you wait long enough. The profits from betting against fear are never really yours. You're just borrowing them from the market until the day it decides it wants it all back, with interest.